Hello and a very good afternoon. You're watching Closing Trades on ET now. I am Snehi Shah and well, this is the last lap of the market, an hour and a half to go for the day to wind down. Let's take a look at what the Nifty is doing. We've been absolutely range bound for today's session. We've been in a tight range. 0.1% lower right now on the Nifty 50. We're trying to hold on to that 23,950 mark, but we've slipped below that. But throughout the trading day, more or less, we've been above the 23,900 mark. For the sensex too, lower by about 0.1%. The broader end, however, continues to look resilient, and in fact, it is gaining strength nominally because if you see the mid-cap index, that's up by 0.5%. The Nifty small cap is also up by about 0.6%. So good show of strength coming in from the broader end of the market. Speaking of the India VIX, continues to be soft. It's a 1.1% cut over there. There's nothing to complain about on that front. But if I take a look at what the sectoral tilt is looking like in the market, it's actually quite even Steven on that front, because while you have the Nifty defense that's up 1.5%, followed by realty, auto, pharma, oil and gas and energy. On the flip side, the biggest cut today is coming in on Nifty IT on the back foot with a slash of about 2.25%, followed by a 0.7% cut in Nifty FMCG, PSU banks, media banks, metals and finance. They lag behind. So that's the kind of setup that we're seeing in the market right now. Just pulling up the Nifty 500 and actually quite even Steven over there as well, with the needle slightly in the favor of the advances. So on that side, you've got an Ola Electric that's up 9.25%, of course, on the back of that Delhi EV policy push news. Vijay Diagnostic, Gland Pharma, Maruti on the back of an upgrade coming in from the house of Jeffries, and a hike in target prices up 5%. Samman Capital, Ather, Cochin Shipyard are some of the stocks that are doing well. On the flip side, it's Schneider Electric lower by 5.5%. Birlasoft, RR Kabel, Eicher is the biggest casualty of the day from the Nifty, because you've got a 4% cut on Eicher Motors, given that the Delhi EV policy is favoring EVs and Royal Enfield has very limited exposure to the EV two-wheeler market as of now. So on the back of that and on the back of their ICE portfolio, you've got Eicher that's under pressure, as is the case with KPIT Tech, Latent View and Tata Tech. So yes, some of the IT stocks are very heavily under pressure. Just pulling up the Nifty IT and taking you through what the move is looking like over there. It's the mid-cap end and the large cap. So it's quite a mixed bag from the IT space in terms of the biggest losing contributors. It's LTM, TCS, Wipro versus HCL Tech. So more larger names compared to the mid-cap ones who are seeing a decline. It's only Persistent Systems on the back of that Nagarro acquisition that we've seen over the weekend that positivity is playing out even today, but to a very mild extent. Flattish moves on Persistent as well. So that is what the market breadth is looking like right now. But let's also take it across to my colleague Avi, who's joined us on the show with a list of all the stocks that are buzzing at this moment. Avi.
Some of the stocks that are buzzing in trade, starting off from Dishman Carbogen, which has announced a 12,000 kp ground-mounted photovoltaic system as commissioned in Switzerland, and it involves around 2,500 modules, and they have done it with partners like IWB and Pleneco. So they will be using it on site for their energy consumption and will be saving on the carbon dioxide emissions, which aligns with the company's sustainability goals, and that is the reason that Dishman Carbogen is seeing some buying. Moving on to Godrej Property, has advanced by around 2.5% on back of news that it has acquired around 47 acre of land parcel in Chennai for developing a project that has a potential of 1.2 million square feet, and the GDV for this land is in the range of 500 crores. Up next is Manorama Industries, which has come out with its QIP floor price of 1547 rupees with a potential discount of up to 5 rupees, up to 5% with a face value of rupees 2. Our next pick would be Crest Ventures, which has advanced by around 3.5% on back of striking a deal with Prafulla Cooperative Housing Society in Dadar East with a GDV value of around 2,200 crore rupees. This reinforces their focus on premium urban redevelopment in high connectivity areas.
Okay, Avi, thanks so much for taking us through that. So yes, that's a basket of all the stocks that are in focus right now. Shifting conversation, let's focus more on the fundamental structure of the market right now. We've got Mr. Deepak Gupta, the Head of Research and Senior Fund Manager of Equity at JM Financial Asset Management, joining us on the show. Mr. Gupta, hi, good to be speaking with you. Wishing you a very good afternoon. Give us a sense of how you're looking at the market right now. What is sentiment like right now? Because, you know, on one hand, crude prices are looking like they're under control right now. The geopolitical sentiment is also looking largely favorable. And while the market continues to be range bound, we've not seen massive cuts like the ones we were seeing a couple of months ago. Give us your sense on how you're looking at the market right now and if the outlook is optimistic.
Good afternoon. Thank you for having me over here today. Our view on the market currently is that India has massively underperformed global markets over the last 2 years. All our indices have given low to mid single digit returns on a CAGR basis for the last 2 years, while developed market peers have performed exceedingly well. Their broader indices have grown by almost about mid teens. So India's valuations are far more attractive than where they were 2 years back. The valuations are far more palatable. And hence, we do think that there are a lot of positive events that have taken place in the markets, in the Indian markets over the last few months. Of mostly being the fact that Reserve Bank of India has tried its best to ensure that the currency volatility reduces. And we do think that FCNR deposits, which they have announced, which could basically help currency stabilize in the coming months, given the fact that in 2013, FCNR deposits as an exercise were extremely successful. And we do think that once currency stabilizes in a meaningful manner, we could see large FII selling, which has been taking place on a consistent basis over the past 1.5 years, should ease off meaningfully. And that can help our markets to regain some of the ground that it has lost in the last 1 year.
Okay. And Deepak, before we get into specific sectors, give us a sense on how you're reading the overall sectoral move right now. Where is the bias right now, and sectors that you would avoid at the moment? Give us both ends of that argument.
Sure. So the sectors where we are more sanguine on are sectors relating to the manufacturing sector, because given the fact that we've seen multiple wars being fought and global crisis being witnessed over the last 4 years, it is extremely important for a country like India to be Atmanirbhar. And I think government is also putting a lot of emphasis on reviving the manufacturing setup in the country. So we think anything relating to the manufacturing activities in the country would largely benefit. This could be capital goods, infrastructure, utilities. Anything relating to manufacturing should be a key beneficiary, and those are the sectors where we are where we are meaningfully overweight on. Apart from that, we also think healthcare as the vertical will continue to move forward in a meaningful manner, given that they largely benefit from the currency tailwind, given the fact that INR has been depreciating rapidly against the dollar. And secondly, the demand for pharmaceutical products as well as premium healthcare services have been extremely consistent, and to some extent is recession proof. So we think healthcare as a segment is a very promising sector, and we are very sanguine on that segment. The sectors where we are slightly more circumspect are sectors relating to oil and gas and energy, given the volatility of crude oil prices. And we do think that it's very difficult to predict where crude will land up, given the fact that the West Asia crisis still persists and is likely to persist for some more time. So that's a sector where we are slightly more circumspect on. And apart from that, the favorite whipping boy of the markets, which is the IT sector, which is facing meaningful headwinds, given the fact that artificial intelligence is the buzzword and has taken over the imagination of all investors who invest in the information technology sector. I think that sector will continue to be under pressure for some more time.
Hi Deepak, this is Harsh also joining in. Very curious to know, so how should one look at IT? Do you believe terminal values are going to get impacted? Do you believe that it's going to be near-term headwind and thereafter you'll see a bit of pickup? You know, when we're speaking to a lot of IT companies, they're saying that growth as such continues to remain decently strong, at least in terms of the outlook. So what's keeping you circumspect?
So I think the way one should look at IT sector is whether these companies are able to grow their earnings in a meaningful manner on a consistent basis, and how well do they utilize their free cash flows, because it is very important in the given context that a lot of free cash flows that many IT companies generate should be utilized in developing the business further. And hence, we have also started seeing a trend of a lot of IT companies looking at doing multiple acquisitions globally. And I do think it's a healthy sign. And I think it is extremely important that the IT companies continue to gain scale and try to expand their horizon. broaden their presence across multiple verticals. So I do think it's work in progress, given the fact that the product business for majority of Indian IT companies is still quite weak. I think a lot of emphasis would be put on that segment, and I think it may take some more time for the sector to get investor interest again. But clearly the balance sheets are much more stronger than where they were maybe a decade back. And I do think that as IT companies utilize their cash flows well, the sector could get re-rated in the coming years.
So no impact on terminal value. It's only about cash flow utilization. You're saying rather than dividend the cash back out to shareholders, you'd probably have to go out and invest for the next couple of years. That's how you're seeing the story evolve. But when you're looking at IT companies per se, they're trading at probably a decadal low in terms of the 1 year forward price to earnings. Do you therefore believe that this could well turn out to be the opportunity over the next 12 months, or you still believe that the street will remain worried even over the next 12 months? Because what a lot of people are also telling us is that currently it's the AI wave. The services wave will come after the AI and the disruption is over.
So while there is valuation comfort, there are no two ways about it. And hence, the IT sector can always see a sharp recovery as and when value factor starts working more effectively in the market. But for the performance to be more sustained, growth has to pick up meaningfully. IT companies should be able to report growth which is higher than the nominal GDP growth rate for the sector to get re-rated and to get investors' interest to get revived. And that will take some more time, in my view, but things could change if depending on the market mood and sentiment.
Okay, and what about financials, Deepak? I wonder where within financials are you seeing value?
So I think financials currently are witnessing a sweet spot given the fact that asset quality remains reasonable. I think asset quality has been extremely stable for the past few years, ex of MFI sector. And in the MFI segment as well, asset quality has started showing signs of improvement. Apart from that, and then when more and more banks raises FCNR deposits, this could actually be beneficial for their NIMs, given the fact that the bulk of these FCNR deposits will not carry regulatory costs such as CRR and SLR. So hence, there could be a possibility for many financial services companies on the lending side to improve their NIMs. And the fact that the costs are very much in control, and most importantly, valuation is extremely reasonable. So I do think that lending segment of financials should do well going forward. The non-lending part of financials have been doing extremely well, be it asset management, broking, capital markets, given the fact that the equity markets have expanded leaps and bounds over the last 3 to 5 years. And I think that is likely to sustain in the medium-term basis as well.
And, this has been a consensus trade as well, right, Deepak, in terms of the lending financials. What do you believe what's the market worried about? The fact that, you're seeing valuations which have never been seen before and sustaining. What do you think worries the market at this point of time?
So I think the biggest worry that the market has towards the lending part of financial segment vertical is the fact that competition intensity has magnified over the last 24 to 36 months. And given the fact that there's nothing much to differentiate one bank from another bank, given the fact that even PSU banks have revived their IT network, the internet access for PSU banks as well is as good as a private sector bank or any new age bank. So there's not much to differentiate, and hence valuations have come off meaningfully. But I do think that a lot of these banks have meaningful moats around their business model, and if they're able to grow at a clip which is faster than the nominal GDP growth rate, valuations will come back for these banks, and investor interest will come back for many of these banks.
Okay, Deepak, pausing this conversation, very interesting though. I need to slip into a very quick commercial. come back, continue this one. I wonder how Deepak thinks of consumption and maybe the consumer durable basket in particular. It's been a tough summer, or rather a good summer for that set of stocks. Let's talk a little bit about that once we're back. Welcome back. And, before I go back to Deepak, let me go across to Avi. He's here with Delhi's new EV policy because that's triggered a sharp rally in electric mobility stocks. Pure play EV makers, Ather Energy, Ola Electric gained on expectations of stronger demand. Charging infrastructure, battery makers, scrappage-linked companies, all of them moving. On the flip side, the traditional ICE two-wheeler makers have come under a bit of pressure. Avi here with all of the biggest winners and losers.
So Delhi CM Rekha Gupta has come out with their EV policy and the stocks have been buzzing ever since. Some of the strong gainers have been Ather Industries, which was up around 9% yesterday, and Ola Electric, which was up around 10% today. And the battery makers like Exide and Amar Raja have been seeing some strong buying, while charging infrastructure players like Exicom and Servotech are up 5 to 6%, while the ones who are official and formal players in the scrapping segment like MSTC is up by 5%, while on the flip side, the ones who make ICE two-wheelers like Royal Enfield by the name of Eicher Motors has seen some very strong selling pressure because of their exposure to the Delhi market, and Hero MotoCorp is almost down by around 2%. Moving on, we can say, so what are the key details of this EV policy? So this policy will come in force from the 1st of July 2026, and the government will spend in total 15,000 crore rupees over the next 4 years, with 7,000 crores on EV incentives and 8,000 crores on EV infrastructure. They will set up 32,000 charging stations over the next 4 years in Delhi. Talking about the EV registrations, timeline for EV registrations, we can see that starting 1st Jan 2027, only EV registrations will be allowed for three-wheelers and N1 trucks, and starting 1st April 2028, only EV registrations will be allowed for the two-wheeler segment. So that is a big news, and that is what is causing buying in the pure EV play stocks like Ather and Ola, and some sell-off in two-wheeler ICE segments like Eicher Motors. Talking about some of the purchase incentives that the Delhi government is going to come up with is in the two-wheeler segment, we can see that they will be giving 30,000 rupees in year 1, 20k in year 2 and 10k in year 3. While in three-wheeler, they will be giving 50k in year 1, 40k in year 2 and 30k in year 3. While for the N1 trucks, they will be giving a purchase incentive of 1 lakh rupees in the first year. Moving ahead, we can see that the scrappage incentives are also in place for the customers and for the demand. So we can see that two-wheelers will receive a scrapping incentive of 10,000, 25,000 for three-wheelers and 50,000 for N1 trucks, while four-wheelers will receive a scrapping incentive of 1 lakh rupees for the first 1 lakh four-wheelers. Moving on, we can see that the school bus also has to electrify their entire fleet. After being notified, within 2 years, they have to make sure that 10% of their fleet is electrified and 20% of their fleet has to be electrified in 3 years of the notification. And by the time the policy comes to an end, that is the 30th of March 2030, 30% of their fleet has to be electrified. So if I were to sum it up for you, this EV policy is definitely a game changer, as it will make Delhi pollution free, but it is putting some great selling pressure on traditional ICE two-wheelers like Eicher Motors, and the conventional players, the incumbents, are at risk. While talking about some of the positives, we can see that this will lead to higher EV adoption. EV adoption in Delhi has already increased from 7% to 11%. And pure play EV players like Ather Industries are seeing some strong benefit from this. The school bus fleet will electrify, and the charging infrastructure will also develop very significantly over the next 4 years.
All right, thank you for that, Avi. That's a detailed lowdown. Deepak, how are you playing the EV theme?
We do think that EV is the reality, and one cannot shut their eyes to reality. So one has to have meaningful EV exposure in their portfolio, and there are very limited names in the EV segment. We also playing EVs through some of these names. But having said that, I would like to highlight that Delhi is not India. While Delhi has implemented this policy, which will be effective from 2028. But let's understand one thing, that India still needs to develop its EV infrastructure in a meaningful manner, and hence one cannot ride obituaries of ICE automakers. They do have a business, and they will survive, and they will find ways to navigate this. Many of the ICE manufacturers have already made meaningful foray into EV segment. and they will restructure they will restructure their organization to ensure that they can get meaningful market share in the EV segment as well.
And how else are you playing consumption, Deepak? Of course, Delhi is not EV, EV is not Delhi, but give us a sense, you gave us a pulse of it being some part of your portfolio. Give us a sense as to how you play consumption and how you're looking at consumer durables in particular.
Sure. So on the consumption side, I think premium segment of the consumption continues to perform exceedingly well. The fact that India still has a per capita income of $2,600 and aspirations are there to eat better, to look better, to wear better, to feel better. And hence, any companies catering to the premium side of the market continues to perform well because the demand has been fairly inelastic in that part of the market. So we have meaningful investments in companies which are catering to the premium side of the consumption segment. And as far as consumer durables are concerned, we all know that the heat wave in the country this year has been extremely intense, which will definitely benefit a lot of consumer durable companies which have air conditioner as a segment. And we've also played the heat wave segment through many of these air conditioning companies. Along with that, we also think that as more and more real estate projects are getting readied, many of these projects, many of the flats will need to be equipped with the latest consumer durable products. So we do think that there is a lot of runway for consumer durable companies to grow their revenues over the next 3 to 5 years.
You spoke about earlier, you spoke about how oil and gas is an avoid. You also spoke about how power is an avoid. Give us the thesis there because, I mean, it looks like a decadal theme for many. So where is it that you're seeing a possible worry there?
So again, on the utility side, we are positive. We were more negative on the energy side of the business, given the fact that it depends a lot on the government policies, which could change based on how crude oil prices are performing. On the utility segment of the market, we remain optimistic, especially on the thermal side, given the fact that the power consumption in this country is only going to go up meaningfully, and thermal segment is the only segment which can give you reliable power. We are still trying to figure out ways to store renewable energy power, and hence battery energy storage as a segment becomes extremely vital. But that segment is still at a very infancy stage in India. So we are more optimistic on the thermal side of the market, on the utility side. Having said that, even renewables will do reasonably well over the next 3 years, but we still have to figure out how to store the power which is generated by the renewable energy segment, and hence battery energy storage becomes a very crucial segment in the coming years to come.
Okay, Deepak, thank you so much. Very good having you. Very good having your views and thoughts.
Thank you so much for your time.
All right, what we'll do is slip in a very short break, come back with more. Stay with us here on ET Now, plenty to discuss. Welcome back, and we're joined by Meryl at this point to give us some of the stocks that are buzzing in trade today.
These are some of the stocks that we've seen in the spotlight in today's trade. Starting first with Shilpa Medicare, the company's wholly owned subsidiary in the biologics space, that Shilpa Biologics, has signed a co-development and a supply agreement with Orion Corporation of Finland. Now, this is for a cancer drug with a massive market. It's got like a $4 billion market globally. And this is obviously a very big opportunity for Shilpa Medicare. It's going to be strengthening the company's biologics capabilities as well as its global partnerships. Also in radar in the Pharma pack today is Alivus. The company is firmly in focus today after Kotak Securities has reiterated its buy rating on the stock, along with setting a target price of 1,315. Now, the brokerage has also maintained its positive stance given its visit to the company's Ankleshwar manufacturing facility. On the other hand, Zaggle is in focus after the company's entered into a 5-year agreement with APAC Financial Services. This is a development that could support business growth as well as client expansion for Zaggle. And we are also seeing Pondy Oxides buzzing in today's trade. It is in focus after ICICI Prudential Mutual Fund has purchased a 4.72 lakh shares in the company in a bulk trade. And finally, in the pharma pack again, Aurobindo Pharma is in focus. It has recently completed its acquisition of Lannett in a $250 million transaction following the regulatory clearances that it had recently received from the FTC. So yes, these were some stocks that we've seen gaining traction in today's trade.
Of course. Okay, thank you so much for that, Meryl. Let me go across. Shivangi Sarda joining us as well from Motilal Oswal. Shivangi, hi, good afternoon. Great having you. How are you seeing the Nifty? I mean, there's very little strength, frankly. And I mean, we gave up some of those early morning gains, very mild gains, but we gave those up. We've seen a bit of a recovery thereafter. How are you seeing the market?
Very good afternoon, Harsh. We've seen that the markets have been trading in a very volatile manner of lately. And of course, today's monthly expiry, so we had to discount it for that. But overall, if we see that smart buying is seen from the lower levels, just a few minutes back, we've seen that there has been a massive recovery from the lower levels. And the index is kind of, flirting around the 24K psychological barrier. So once it manages to cross this level, then we could see an up move towards 24,400 marks. But overall, there will be some sort of, range bound move of lately. Of course, on the expiry note, we are closing on a slightly positive note. But overall, July series have tend to be quite positive. 8 out of 10 years in the last in the last decade that we've seen. So July series, tends to be positive, and we're looking out for a few sectors to capitalize on that. So buy and decline to continue here with the support of 23,750 levels for Nifty. Talking about Bank Nifty, we've seen that some of the private banks have taken a back foot after a good rally, but Bank Nifty is been consolidating in a very tight band. Not much of a movement expecting the monthly expiry, but overall, we are looking at 57,500 immediately, and then 57,000 slightly positionally for Bank Nifty, with an upside move towards 59,000 levels.
Right, okay, that's the take coming in right now. The index and the Nifty Bank is up to extremely sideways a session, even though those jagged edges are clearly telltale. But having said that, it's been a very narrow band from the high to the low of the day. Maruti, that's the one which has spurred up so nicely. It's holding up almost 5% now. Titan has sprung up a good 3% as we speak. And then there is a Bajaj Finance along with Tata Motors PV, which is also scaling higher as we speak right now. A 3% move coming in Bajaj Finance. 1,008 is where that stock is. And Tata Motors PV as well is currently skirting around the 355 odd level. Having said that, the one which has been consistently moving up, and that's been Eternal really, along with, of course, Trent. While I think Trent today is holding up 1%, but it's been a very, very consistent performer of late. Shivangi, on to some of these consumption plays, Titan, Eternal and Trent, and where do you see a plausible trade?
Very good afternoon, Aisha. So out of the names that you mentioned, of course, Titan has been one of my favorites, and the kind of short covering move that we've seen in today's session is quite remarkable. The spot in some of the OTM call options was signifying that, there is some activity which is happening in the first hour that we noticed. Of course, it's also surpassed its previous hurdle band of 4,400 levels and now getting ready for a good up move. So this one's on radar. We're looking at the next targets of around about 4,600 on Titan immediately, and then slightly positional 4,700, and the support could be seen at 4,300 odd levels.
Okay, in the meantime, the one space which is charged up has been Electra as well as Atul Auto, and both of them are in focus post the Delhi government's EV push. In fact, we spoke with the managements of the companies. Here are what they had to say about the material gain that they foresee from the Delhi EV policy.
I think it's a very positive move. We have been expecting this policy 2.0. Delhi government is very progressive. I would say that they have an incentive scheme as well as a mandate scheme. Both of them place well. I think all the intra-city registrations from July 1 is going to be only clean fuels, which I believe is electric. and hence it's going to be a positive for all of us who are in the EV industry. I think not only buses, I think trucks, looking at two-wheelers, three-wheelers, and cars. I think all of them have a clear incentives for next 3 years and a mandate from 2030 onwards.
It's quite positive for the industry, three-wheeler industry, and in particular Atul Auto as well, as we are into all fuel and particularly with hype in EV, we expect that definitely it is going to help us in a great way. I believe we will be definitely able to deliver much better than what we delivered last year. But really difficult. It's just a beginning of, the year. We are about to end the first quarter. So let us wait for another couple of days to see the first quarter result. And I am quite confident that we will be able to deliver much better numbers and volume for FY27.
Okay, that's the take coming in from the Electra management. And that, of course, is one stock which has been doing very well. And right now as well, both Atul Auto as well as Electra holding out very smartly. The casualty from the EV policy has been, of course, iShares today. Shivangi, want you to come in on the charts and whether you foresee further weakness on iShares?
What has been quite volatile of lately. It did made attempts of recovery here in the series, in the start of the series, but then it failed to negate. Aisha was one of the candidates as well, and we've seen that the OI surge in the last two sessions has been quite significant. That means the short build-up is kind of getting carried along in the series. So I would, see a little bit of more weakness and range-bound move over here. We could expect, levels of roundabout 6850 odd levels for Aisha. There's still more space for a range bound or time-wise correction at this one.
Okay, there could be some time-wise range-bound correction that one could see on iShares. But stepping into a new month soon, and history suggests that July has been one of the strongest months for Indian equities. Over the last decade, the Nifty, the mid and the small cap indexes have all ended the month higher in 8 out of 10 years, with metals, pharmaceuticals and IT being the best performing sectors on a seasonal basis. In fact, Ashesha is here with that insight on how July is likely to pan out.
Historically, July has turned out to be a good month for Indian equity markets. On an average, Nifty has given returns of more than 3%. That's how the Nifty 50 performance has been. But the broader markets, much in line with what we see normally, continue to outperform the Nifty 50 index. So mid-cap index has given an average return of 3.3% over the last 10 years. And small-cap index has given an average return of about 3.6%. As I mentioned, July has historically always been a good month for Indian equity markets. Let's also take a look at the segment-wise performance then. And Nifty Metal continues to outperform with an average return of 4.4%, followed by Pharma and IT with an average return of 4.3%. And we also have energy, PSU banks, FMCG, banks and auto, all of them giving returns anywhere between 2 to 4.5% on an average in the last 10 years. Let's also talk about a couple of other sectors and how they have performed and how a performance has been for other sectors. We did talk about Pharma with an average return of about, in fact, it has given positive returns in 8 out of the last 10 years. We have auto, IT, FMCG, energy, banks, all of them giving positive returns of anywhere between 6 to 7 times out of the last 10 years, which means the probability of these indices ending in the green in the month of July this year stands anywhere between 60 to 70%. In fact, even PSU Bank and energy indices have given returns 6 out of the 10 times in the positive territory. So clearly, as I mentioned, most of the sectoral indices have ended in the green and they have given positive returns anywhere between 6 to 8 times out of the last 10 years. So yes, July is expected to be a good month, and now with geopolitical uncertainty out of the way and earnings season around the corner, we are expecting a good month for Indian equity markets.
Right, okay, that's of course the seasonality impact, but July would also mean that we'll have the auto sales for the month of June which are expected to be declared. And we are expecting or anticipating it to be a healthy one across segments. Tata Motors passenger vehicles, M&M are likely to lead the growth amongst car makers, while Royal Enfield, TVS and Bajaj Auto are expected to post strong gains within the two-wheeler segment. In fact, Avi is here to quickly tell us what the street is expecting.
The auto sales number for the month of June are going to come. So let's have a look at the preview of what the numbers can be and what are we expecting. Starting off from the PV segment, the OEMs have come out with a series of launches and the rural demand has also recovered. So what we can see is a good year-on-year growth. Starting off from Maruti, we are expecting sales of around 221,000 units, with M&M Auto coming in at around 98,900 units, with Hyundai coming flat at around 61,000 units. While it is important to note that in Tata Motors PV, the base was low for the last year, so we can see a big growth of around 58%, coming in at around 59,000 units. Talking about the CV segment, we are seeing good traction in the CV segment, and the infrastructure push along with pre-stocking before the BS7 kicks in is also leading to some good volume gains in the CV segment, with the Tata Motors CV clocking in around 34,300 units and the Ashok Leyland clocking in around 16,100 units, with Eicher Motors coming in at around 7,780 units, which is 6% up on a yearly basis. Talking about the two-wheeler segment, we can see that broadly it has grown on a yearly basis, while there is some dip on a monthly basis. That is because of the onset of the monsoon season in June, and that is a seasonality that happens every year. So no concern there, but on a yearly basis, good growth starting off from Eicher Motors at around 108,000 units, which is up 21%, and huge growth in TVS Motors, that is 30% up on a yearly basis at 521,000 units. Hero Moto coming in at around 559,000 units, and Bajaj Auto at around 448,000 units. Talking about the last segment, that is the tractor segment, it is the Kharif season and the MSPs have also increased, so that is leading to some good volume share. But it is also important to note that the El Nino is in place, and it is we can see that the rainfall has been below average, so that remains a key monitorable. Talking about Escorts coming in at around 13,830 units, which is up 12% on a monthly basis, and M&M Tractor coming in at around 60,500 units.
Okay, that's a color on what we can anticipate from Motown come the June sales. Maruti, of course, has been going strong, like we've been telling you, Tata Motors PV as well. But Shivangi, throw some light on where is it that you're seeing strength and tradable opportunity within two-wheelers specifically, TVS, Bajaj Auto or any other?
Absolutely. Two-wheeler space has kind of gained a lot of attraction of lately. But, some of the names are still showing early signs of short covering. And I would rather, little wait and watch here, Aisha, because many of the names are showing kind of a lower top, lower bottom structure on the weekly basis. So little wait and watch here. On the contrary, my focus would be on some of the defense names which have shown a good amount of recovery and a consolidation pattern finish altogether.
Right, okay, that's that on two-wheelers. But the one space which continues to stick out like a sore thumb has been IT. And Shivangi, help us with the charts, because we've seen multiple breakdowns now on the Nifty IT index alone. And even if you look at just individual charts, Tata Elxsi, KPIT, we all saw what happened to Persistent yesterday after that mega acquisition that they announced. And then, of course, some of these benchmark IT names, the likes of TCS, Infosys, Wipro, HCL Technologies, the list goes endless. They continue to be quite under pressure. Any signs of a dead cat bounce or even a material rebound for that matter?
Absolutely, yes. I remember Harsh throwing this question on me last week itself. And we've seen that IT pack has been one of the most laggard space in this entire 2 years. And, talk about any stock, any attempts of recovery have been kind of negated. And the entire sector is kind of moving in a headwind. So overall, any stock we're just trying to hold up is kind of facing some bit of resistances here. But out of the lot, Coforge is one stock which is kind of resilient in terms of the entire pack. And we've seen that this is fairly doing well as compared to the others. Even on the monthly basis, it's making higher top, higher bottom from the last 4 odd months. So this one could be kept on radar, if at all, in the entire IT space.
Okay, Shivangi, hang in there. Lots more to chat about with you. I'm going to take a quick break and be right back for more. Back with closing trades right here on ET now, and just reiterating the closing trades. It's been very range bound and sideways this session. Saw a breach of 23,900, picked up a little bit from there. 23,940 is where we're currently at. Select autos like Maruti definitely powering ahead, along with Tata Motors PV, Eternal, Titan, Bajaj Finance, Adani Enterprises, along with Ports, ONGC and Interglobe are your key winners in trade, but it continues to be weak for the entire IT pack. No exceptions there. KPIT, LTM, Tata Elxsi as well are all falling down. iShares, of course, is a key drag today. Tata Consumer, along with Unilever and ITC as well, weighing heavy on the indexes. Some of the large caps like a Kotak, SBI as well are the drags, and ICICI Bank too, which is down nearly about 1%. That too is weighing heavy on the indexes this afternoon. But yes, look at a Polycab, that's holding up 4%. The breadth of the market once again is outshining what the benchmarks are doing. A Sammaan Capital, which is also clocking about a 5% move. Cochin Shipyard is higher by 5% right now, 1,500 levels on that stock. And Solar Industries, which is also higher by 5.5% as we speak right now. But Anand Tandon as well joins in to talk about what he's making of the market right now. Anand, afternoon. Good to be having you on the show. Anand wanted to understand, just on the cusp of the Motown verdict or sales numbers for the month of June, while it is anticipated to be a strong set, that and the Delhi EV policy, where is it that you're picking your winners from autos?
I think autos have already been one of the better performing sectors, so it's not as if there is anything much to be discovered there. Of course, the Delhi EV policy does throw a bit of a twist in the game because there are clear winners and perhaps not so much. But for example, iShares, to my mind, the fact that it has been beaten down so much probably gives you an opportunity to relook at it, because people who are buying iShares Motors vehicles are not buying them because they are light and swift on their feet. They are buying them because they represent something in terms of historic value and the classic design. And therefore, though there may be an immediate reaction given the fact that they are not benefiting from policy, it doesn't mean that their market share is likely to get, or at least the people who buy those vehicles are likely to get influenced. Net, I think this is one sector which will likely continue to report decent numbers. The only challenge is that most of the companies are now trading at valuations, which when you compare them to international valuations are largely eye-popping. I mean, if you look at any auto company, for example, globally, it will trade at 3 or 4 times EV to EBITDA. And barring Tata Motors, which has obviously a significant international presence, all the rest of them here trade closer to between the mid-teens and late teens. So it becomes a little hard to justify why this kind of number should exist in terms of the valuation. But that said, if you're looking at the Indian market, it's clearly one of the better performing sectors.
Yeah, it surely is and has been the case. Although, Shivani, today on some of these individual names, and I want to talk about buzzers for sure. Look at a Polycab, for instance. That's spurred up quite nicely. And I can see a good move on a Sammaan Capital and on a Cochin Shipyard as well. Just analyze these 3 charts for us.
So looking at Polycab, we've seen this is this is one stock which is traded in an upward sloping channel from quite a long time, and we've seen that it has respected its immediate exponential moving averages as well. From the last 50 odd trading sessions, we've seen that any small declines have been absorbed here with kind of crazy good buying. Now, this one's looking quite positive even for the upcoming sessions, and we're looking at next targets of around about 10,400 for Polycab on an immediate basis. Now, talking about the other stocks that you mentioned, Cochin Shipyard has seen a kind of a reversal from the lower levels, and we've seen a slight bit of bottoming out structure on the weekly basis, but this one requires a decisive follow-up buying here, or else it would, be a range-bound case here. So we would actually attempt to buy if it manages to hold above 1550. Quite a stretch, but this will be a safer zone to start buying and accumulating this one, given the kind of range-bound move in the last 5 weeks.
Right. And what about a Sammaan Capital? That as well has been a strong one of late.
Yes. So talking about Saman Capital, this one's kind of moved after the last 4 weeks of weakness. A good amount of volume surge in today's session, which is quite positive. But I'm looking at some bit of resistance here. It did try to surpass its previous resistance zones, earlier this month as well. But we've seen some bit of consolidation. If we talk about the level, I'm expecting this stock to move in a range of around about 172 to 185 levels.
Right, okay, that's the take coming in on some of those big buzzers in trade right now. But also some news coming in with 100% FDI now allowed in insurance. Will global insurers flock to India? That's the big question. In an exclusive chat with ET Now, the IRDA chairman, that's Ajay Seth, says that foreign investors' interest is very strong. With new licenses approved, global life insurers are surely eyeing India.
Ours is a fast-growing economy, rising income level. Life insurance sector is growing just about at the same rate as the economy. Last 10 years, economy become 2.5 times nominal rate, nominal terms. Life insurance also became 2.5 times. General insurance grew 3.5 times. But both are growing, but not adequate enough, giving that a large unmet need in the economy. We should be growing much, much faster. In fact, just about 2 months back, two new licenses were approved. In today's meeting of the authority, one more license was approved. It will come out in the release shortly. There have been requests, or rather we have already approved one of the foreign investor, rather a promoter, going up to 100%. Then there are a couple of other applications which are under consideration of the authority. So a lot of interest coming. More interested on the general, but recently one big player also has applied on to come into not as a green field but as a brown field in the life insurance sector as well. So it's showing a lot of interest.
Okay, that's the take coming in from the IRDI chairman, and that entire conversation, that is, you can catch on Thursday evening. But that said, just looking at the market right now, extremely sideways a session. And Anand, before we know it, it'll be time for earnings season yet again. Any positive or big negative surprises that you anticipate, considering this is the quarter where the real impact of the West Asia crisis is going to be felt?
Yes, and I think I would imagine most companies will report slightly more subdued numbers, but I think the market pretty much knows that. And therefore, it may not be something that is going to come as a surprise. So if you're looking for surprises, we still have to wait for them, because obviously it's a little difficult to predict where the surprises will come from. Clearly the big sectors like energy, etc., will show somewhat subdued numbers. The metals, etc., should have no particular, they are reasonably predictable given the fact the prices are well known. And the auto numbers are also there. So, you are looking for surprises. It has to be in areas like chemicals, etc., where it's a little difficult to figure out how any particular subsegment of that has done. I think one of the sectors that is likely to show good results will be the textile sector. Especially cotton textiles, because given the fact that some of the petrochemical-based substitutes had become fairly expensive, the margins should have been given an opportunity to expand. So I would expect that one area to do reasonably well. For the rest, it should be pretty much in line.
Makes sense. Okay, the big one, of course, all through last evening has been the 4 major banks which are in focus and have been. HDFC Bank, which has now appointed Rajiv Kumar as the chairman and named Puneet Sharma as the CFO designate. Axis Bank will react to, or rather is reacting to Sharma's resignation, while Bandhan Bank CFO Rajiv Mantri has also stepped down and is expected to join Axis Bank. Mitali, my colleague, is here to summarize all the developments and how the market has perceived this news.
Right, so we see that India's banking industry is actually playing a high-stakes game of executive musical chairs, with the CFO seat being the hottest one right now. So it starts with Axis Bank. The CFO, Puneet Sharma, he resigns after 6 years from the bank, but he's not leaving banking entirely. He's actually heading to HDFC Bank to take the position of CFO there.
Now the domino falls and Bandhan Bank is up next, where CFO Rajiv Mantri resigns and moves straight to Axis Bank, replacing Puneet Sharma. Meanwhile, HDFC Bank's veteran CFO Srinivasan Vaidyanathan is set to retire in October, paving a way for Puneet Sharma to take the charge here. HDFC also adds heavyweight former Finance Secretary Rajiv Kumar to its board as additional independent director as well as part-time chairman, subject to the RBI approval. But here's the twist. The chain began at RBL Bank. After its CFO existed last year, the bank appointed Bhavin Lakpatwala, who spent nearly 15 years at HDFC Bank and as its new CFO. So if you connect the dots, first it started with RBL Bank, moved to HDFC, then Axis, and then Bandhan Bank also announced their CFO resignation. So this isn't actually a few resignations. It is one of the biggest CFO reshuffles that India's private banks has ever seen in the years. In the banking, money is the only thing that we see right now. Sometimes the people managing it too. That is what being showcased by the private lending banks.
Okay, that's the take coming in on banks. And let me welcome on board Lakshmikant Shukla as well. Lakshmikant, great to have you on the show. Afternoon. How are you looking at the banking pack right now? Kotak, which has been soured from the word go today, then Bandhan, Axis, and of course the big one, HDFC Bank.
Hi, good afternoon to you all. So most of the bank are showing some sort of correction, but if we look at the overall structure of Bank Nifty, so I think from there we could see a strong support around the zone of 57,000. So where its 200 DMA is placed. So as long as it holds this support, we could expect upside move toward the levels of 58,800 to 59,000, and a sustained move above this level of 59,000 could probably open the door for a rally toward the levels of 60,000 mark. But if we look at the structure of the most of the private bank, then I have seen a little bit correction. HDFC Bank is facing strong hurdle around the zone of 815 to 820. If it give a decisive breakthrough of this level, then after positive momentum could trigger, which could push it higher toward the levels of 860 to 870 kind of range. While talking about Bandhan Bank, so it is having a strong support around the levels of 190 to 194. So if it able to hold this support, then probably we could see some sort of pullback. Even in Axis Bank, few days back, it has given falling trend line breakout, surpasses its previous swing high. But from last 2 to 3 days, we have seen some sort of profit booking. So I think around the levels of 1,320 to 1,300 zone could serve as the strong support. If it able to hold this support, then probably we could see some sort of pullback move toward the levels of 1,400 again.
Okay, well, the first half of 2026, and it's now behind us almost, and it's been a tale of sharp contrast, so to speak. While Wall Street, of course, outperformed with S&P 500 index gaining about 14%, the Nifty fell over 8%. Energy, metal stocks, all of them led the gains here in India, while IT clearly was the biggest laggard. Ashesha walks us through the key charts and a glimpse of how the past 6 months of the year have gone by.
The first 6 months of calendar year 2026 have come to an end, and clearly there was a lot of turbulence in the last 6 months thanks to West Asia crisis. So let's take a look at everything that has transpired on a year-to-date basis. First up, look at the kind of underperformance Nifty has shown as compared to US markets. Nifty has declined nearly 8% on a year-to-date basis. On the flip side, we have S&P 500, which has gained nearly 14%, which clearly depicts how underperforming Indian equity markets were in the first 6 months of calendar year 2026. Let's shift focus to commodity markets then and look at the kind of moves that we have seen over there. Gold, it was at the start of the year at about $4,320 an ounce. It has fallen to near 4,000, which means on a year-to-date basis, we have seen a decline of about 6%. But it's not just about the decline. Look at the kind of volatility that we have seen. It's a sharp uptick in the middle of the year when the West Asia conflict broke, and after that it steadily declined with a year-to-date decline of about 6%. Let's also talk about oil then and look at the kind of moves that we have seen over there. At the height of geopolitical uncertainty, Brent crude shot up to nearly $119 per barrel. Since then, after the West Asia conflict cooled off, And after the Strait of Hormuz reopened, crude prices have now fallen to about $72 per barrel, but this is still elevated as compared to pre-West Asia war levels of $60 per barrel, which means they've risen 19% on a year-to-date basis in the first 6 months of calendar year 2026. Let's also put the spotlight on a couple of other parameters. An Indian rupee continues to depreciate. At the start of the year, it was at about 89. It is at 94.3 currently, which means Indian rupee has depreciated nearly 5 times versus the US dollar in the first 6 months of calendar year 2026. Meanwhile, let's also talk about US 10-year benchmark yield. At the start of the year, 4.1. It is currently at 4.3. We have seen an increase of about 20 basis points on a year-to-date basis. So these are the 5 charts which depict how global commodity markets and Indian equity markets as compared to US have performed in the first 6 months of calendar year 2026.
Okay, thank you so much for that, Ashesha. That's the take coming in with regard to the first 6 months, summing it up. But Lakshmikant, let me come to you with regard to some of the names which are buzzing in trade. And Schneider Electric is down 6%. What are you seeing on charts with regard to this one? Is there a call emerging?
So currently, I'm not able to see on my charts Schneider Electrical. So not able to provide the view on this stock.
KPIT Tech, Tata Tech, some of the ER&D companies, those two are seeing some pressure today, 4 to 5.5% lower on both of those.
See, Tata Tech has given consolidation breakdown below the levels of 720 with the formation of bearish candle. Still, it is hovering near its prior swing low of 670 to 660 kind of range. So that would be the immediate support. If it breaks this support, then we will see further correction in Tata Tech toward the levels of 640. So from there, if it formed any kind of reversal pattern, then after we would see some sort of stability, and then after it will see bounce back move toward the levels of 700. So I think we should avoid it currently and wait for this dip toward the levels of 650.
Okay, Anand, let me come to you with regard to a Maruti. You believe that the sales numbers can continue to sustain? They did record numbers for the month of May. June numbers obviously out very soon now, in the next day or two. But can the momentum sustain? Likely, stock is up 5.
We have to see what the numbers reveal, but there is no reason to assume. The basic challenge that Maruti has is the fact that their SUV portfolio is very weak. And in the domestic market, that is where the consumers seem to be shifting to. And the portfolio where they are strong at is at the lower end, which is becoming less favored by at least Indian consumers. So exports need to pick up and make up for some of that gap. Overall, what Maruti needs to do is, despite the kind of cross-badging that they do with Toyota, they need to find better ways to, or at least a better portfolio in the higher-end vehicles to be able to retain their market leadership. In the mid and small segment, obviously, there is no worthwhile competition.
Worried with regard to the way the monsoon has shaped up till now, and would there be sectors which you would likely avoid, just given the fact that maybe the next couple of quarters may be tough from a monsoon standpoint in particular?
Certainly, monsoon is a bit of a concern, but what has happened is that the government is now also stepping up to the plate in terms of various schemes for farmers. So to some extent, over the years, the effect of monsoon gets somewhat mitigated. Inflation is already, to me, looking higher than what the analyst and the RBI, etc., seem to indicate. And I would imagine that food inflation may add a little bit to the worry, but it's now a much smaller part of the overall CPI. So it's not going to be unmanageable. To me, the bigger factors remain not so much the monsoon, but the effect it has on demand. And as I said, so long as there is some other transfer of income that happens or some other support that comes through, it is quite likely that the rural demand, even if it is not at the same level as last year, can actually sustain at a reasonably high level.
Absolutely. Anand, curious to know, what is it that you've made of, this musical chairs that we've seen at the top banks? And, from an investor's perspective, how material could this rejig be?
So yeah, it's interesting to watch people go round and round in circles. But the fact of the matter is that, while money is an issue for banks, and that is what their raw material is, it is not really the CFO who arranges for the money as much as the treasurer. So so long as the treasury team is stable and is doing well and is able to generate profits from their operation, the CFO is, after all, only a reporting entity, and for most parts, these banks don't go out and raise money that often, at least in terms of dilution. So it is not that material what the CFO does. To the extent that there is some amount of effort that may be there in terms of how much provisioning is provided for and so on. There may be some amount of discretion, but by and large, the rules are now much more clearer, and RBI has kind of ensured that you have to kind of show up whatever your real NPAs are. There is, of course, some discretion possible, but for the larger banks, I think that has become more or less standard. So, to some extent, this is not going to impact investors in any significant way.
And PSU versus private, is there a view there, Anand, that you have?
So I mean, I have no great favorites among PSU banks other than SBI. At the end of the day, it is, whenever the markets get tight, the challenge is to get the liability side of the bank in order, and markets, therefore, from that perspective, the private sector banks benefit. The benefits are becoming little less in terms of the IT levels. Even the public sector banks now have similar apps, etc. But all you have to do is knock on the collapsible gate of the private public sector bank to know why it cannot be the preferred bank for any significant, saver.
Well, the other one, of course, has been persistent after that acquisition of Nagarro, which was well critiqued in the market. The fact that premiums were looking rich, growth dilution definitely is a concern. The integration, execution risk as well. Clearly one talking point, and the leverage concern, considering it's an all-cash buyout that one has seen. That said, the stock fell 11.5% yesterday, started off weak again today, and now you're seeing a minuscule of a recovery of about 0.6% or so. In fact, let's hear out what Pankaj Tibrewal, though, had to say earlier today when we were chatting with him about his views on IT. He's got a very contra view, and that he believes that some of the mid-cap IT names have fallen enough to be bought now.
Indian IT having terminal value which is zero, I don't subscribe to that view. I think there will be enough opportunities for Indian IT services as you move ahead, as world adopts AI. I believe that it will be a new stream of revenue for most of the IT companies. After such a sharp correction, actually, from a tactical perspective, we are tempted. From the dividend yields are now between 5 to 7%. Free cash flow yields are looking very attractive. And slowly and gradually, where we believe growth will be in mid-teens at least, those are the names which we are probably being buyers of in the last month or so. So slowly and gradually, we have increased our IT weight in our portfolios, but still we are probably slightly lower than the equal weight. At some point of time, post the first quarter numbers, we will see them moving at least to equal weight, if not overweight at some point of time.
So, well, that's the view coming in from Pankaj Tibrewal as well. But Shilpa Medicare, that's the other one which is in focus after its biologics arm partnered with Finland's Orion Corporation to co-develop and exclusively manufacture nivolumab, which is a biosimilar for Europe. Snehi here with more details.
Well, yes, so the stock of Shilpa Medicare is in focus today on the back of not one but two positive developments for the company. The first one is, of course, its tie-up with Orion, the wholly owned subsidiary of Shilpa Medicare, that's Shilpa Biologicals Private Limited, has signed an agreement to co-develop a drug with Orion Corporation. The product that they are going to be co-developing is called intravenous, that's IV, nivolumab biosimilar, which references one of the world's most widely used cancer immunotherapies, and it is used to treat skin cancer as well as lung cancer. Under the terms of this agreement, now Shilpa Biologicals will lead product development. They will have exclusive long-term commercial manufacture and supplier for Europe from its EU GMP facility in Dharwad. Orion comes in, it will have exclusive rights to register, market, distribute and sell this product across Europe and act as a market authorization holder in the territory. What Shilpa is getting out of this, the consideration is that Shilpa will receive development and regulatory milestone payments plus supply revenue over the life of the partnership. So it's a constant revenue stream in the longer term for Shilpa, and that is why the street is cheering this stock. That's reason number one. The other reason is a fresh buy initiation note coming in from the House of Dam Capital for Shilpa Medicare, wherein they've initiated buy with a target price of 748 rupees per share, which is still roughly 25% higher to where the stock is trading right now. They believe that Shilpa is shifting from pure oncology API to a B2B focused specialty pharma play, and the decade of heavy R&D investments that Shilpa has gone through is now starting to bear fruit for the company. They see margins expanding to 490 bips by 233% by FY29, and they're expecting PAT to double over FY26 to FY29. So very strong note coming in from the House of Dam Capital. Initiated a buy, target price of 740 rupees per share, and of course this co-development agreement that the wholly owned subsidiary has signed with Orion is another key positive for the company.
Right, okay, that's that on Shilpa Medicare. Anand, curious to know what is it that you're making of the pharma tailwinds and whether there's more headroom to go. I mean, not just Shilpa Medicare today, but look at a name like a Gland Pharma, etc., making fresh highs every day.
Yes, I think the market is beginning to recognize that the markets have become much better for the international markets. So the domestic market was already growing at 11 to 13%. And therefore, that was something that was anchoring the growth in Indian companies. But the international market has become much better. And more importantly, there is now some level of innovation that we are beginning to see in some of the companies. I mean, clearly Wockhardt was one, but there are others that have a pipeline now. The latest one that you mentioned is one more such company. From that point of view, I think the mojo is back in terms of the pharma companies. So while it has been treated as a defensive, for now the kind of growth that you're seeing in that sector is likely to sustain because the number of drugs going off patent is again quite large, and along with that there is now some sliver of innovation that is possible. So unlike IT, where we've been left behind in terms of innovation, there may be actually a much better innovation play coming out of pharma.
And Anand, any ideas, any views with regard to export-oriented opportunities? There's plenty of chatter around how exports could be the next big lever or the next big avenue for investments or equity investments. Any sectors on your radar with regard to exports that you're liking from a risk-reward standpoint at this time?
So if you go down the list from the largest to the smallest, right? We start with energy exports. Nothing much that we have a USP on that will continue wherever it is. The next one, which used to add highest value, is IT. Unlike what I just heard another fund manager talk about, all you have to do is compare where Indian IT mid-cap is with regard to, for example, Accenture. Accenture generates 24% ROE, trades at 1 time sales. Persistent generates 24% ROE, trades at 5 times sales. And in terms of growth, both of them are likely to show mid-teen growth. So I'll leave you to make a distinct choice whether or not you would rather buy Accenture than Persistent. So I think I would stay away from IT as something that you want to look at. Even today, there is no compulsive reason to buy it. Next comes, of course, things like textiles and gem and jewelry. As I said already, textiles, especially cotton textiles, to my mind, will do exceedingly well. And in theory, it is something that India has always been reasonably strong at. No particular reason why it cannot get back its mojo. The issues will be in terms of being able to do synthetic textiles. That is something that we have been a bit of laggard on. Auto ancillaries, next big area, we can do well on. That again is something that we already have been doing reasonably well. Again, expect to see continuous growth. The telecom exports that we have been saying, the phone exports, basically the EMS and things like that, to my mind, that doesn't add any value. If you look at the kind of growth that we have seen there, it's been phenomenal. So we've become exporters. But you're getting 2-3% growth. I mean, 2-3% margin in India. And so far, despite so many years, we have not seen much happening there. So non-tone export growth is possible, which basically brings us back to manufacturing in some form or shape. If we are able to set up a manufacturing ecosystem, India can become a good powerhouse. But the question is, for most part, we are still low down in the innovation and sophistication ladder. Just as China has put out its 5-year plan, which is focusing now on quantum, on cloud, on the EVs and so on. We are now talking about solar, etc., where China has 140% of global capacity. So exports are going to be tough for most of the other things, other than perhaps niche areas like engineering exports that do in certain areas and so on. Whatever exports we can do, certainly it will do well. But I don't see us suddenly becoming an export powerhouse anytime in the near future.
Okay, let's just see what the closing trades are settling in at, because it's been an extremely range-bound session for the Nifty, though once again in the last few minutes we've seen a drift down come in, and we're closing in once again sub the 23,900 mark. Lakshmikant, how critical is it, this 23,900 level? Because twice we've breached this mark today.
So even in today's session, when we have seen corrections since morning, it has found, Nifty has found respite near the levels of its 50-day SMA that is placed around this same level. So if it breaks this level, then further correction is possible toward its major support of 23,750, where its 20-day SMA is placed. But I think that we will start a new month with positive momentum, and Nifty could see rebound from the levels of its 50-day SMA, and again it will going to retest its recent swing high of 23,260 to 23,300 zone. And if it will give the breakout from the levels of 24,300, then after it will resume its upside momentum, and we will soon see Nifty is going to touch the levels of 24,600 in this upcoming month.
Right, okay, that's that on the index. While IT definitely has been the weakest link today, throw in a couple of these FMCG as well as select auto plays as well. Banks too have had it heavy today with ICICI Bank, Kotak, Axis, SBI, all in the week. And then, of course, on the flip side, they've been, select auto names like a Maruti, which have done well. Tata Motors PV managed to hold out. Bajaj Finance and Shriram from the NBFC pack have done good. Adani Enterprises, Adani Ports, ONGC. There's been Titan, which has done well today. And then, of course, a huge spurt in names like a Force Motors as well, in a Solar Industries, and Cochin Shipyard, which has seen a one-way spurt up today. 5.5% of an uptick is what that stock is closing the day with. 6.25% in the cash markets, 1,500 plus levels on Cochin Shipyard. So that's been really one strong name in today's session. Bajaj Holding has also been very active, not such a liquid mover, but managed to close in at the high point of the day around that 10,529 odd level. Auto Pharma has also been very actively traded, a good 2.5% uptick. In fact, Pharma across the board has been a very, very strong performer all through this month. Lakshmikant, before we wind up for the day, any trades within Pharma which you think can still be carried on?
Recently, Torrent was breakout of the levels of 4,600 and still holding these levels. So I think their risk reward ratio is favorable, and we expect upside movement Torrent Pharma toward the levels of 4,850 to 4,900 kind of zone, with this stop loss of 4,520 on the downside. So as long as it holds this level, we expect positive momentum. So I think Torrent Pharma is one of the good call from the pharma space. Second one is Cipla. Cipla has given a range breakthrough of the levels of 1,380 and 1,480. In today's session, it has seen mild profit booking, but I think till it hold up the levels of 1,410, we will remain positive, and we will expect a positive momentum in Cipla toward the levels of 1,520.